I valued CrowdStrike and I come up with a stock that is 42% too high. The price that I come up with as a value for the company is $244 per share, but the company is priced on the marketplace for $423 per share, representing a 42% premium. Based on cash flows, the cash flows for CrowdStrike are substantially lower than Palo Alto. Palo Alto is about 3 billion, and this one's at 1.296 billion for the first 12 months. I'm growing cash flows by 25%, just like their growth rate tells me on the company, and long-term growth by 5%. So the cash flows add up to being worth 32% less than their current stock price. The earnings per share is even more drastic of a premium. I use their earnings per share. I give them a P of 36. They are growing at 25%, which is good. Now, again, I compared them to Palo Alto, same type of business. Palo Alto is growing faster if you measure by dollars. CrowdStrike has a higher percentage because they're smaller. So I'm going to use the same PE as I look at both stocks. And when I do that, this one reveals a 62% premium. Combined, it's a 42% premium. So CrowdStrike's priced rather expensive. If their growth rate on their revenue ever decreases more than expected, let's say it hit 15% revenue growth in a quarter or two, I would expect this stock's really going to sell off because investors are hanging on the fact that this is a high growth stock. But I would argue that it is a growth stock, but I think over time it's just going to become like the rest, just a moderate growth stock.